Hello everyone, this week we are going to learn supply, demand and government policies. Economists are also policy advisors. They use theories to help change the world for the better. Policies often have effects that their architects did not intend or anticipate. So these policies include price controls and taxes. In this chapter we are going to learn first price controls and their impact on the prices and the quantities and market outcome, and then we talk about taxes. Let's start with the first price control, price ceiling. Price ceiling is the legal maximum on the price at which a good can be sold. A very good example for a price ceiling is rent control laws. For rent control laws, the landlords cannot increase the rent above the legal maximum. Price floor, on the other hand, is legal minimum on the price at which a good can be sold. A good example for price floor is minimum wage laws. So businesses cannot pay lower than the minimum wage to their workers. Let's read this from the experts. Local ordinance that limit rent increases for some rental housing units, such as in New York and San Francisco, have had a positive impact over the past 3 decades on the amount and quality of broadly affordable rental housing in cities that have used them. Unfortunately, economists do not agree with that statement. So they don't think rent control policies have consequences that we want to have, and they have unintended consequences. Actually, it does not increase the quality and amount of affordable rental housing with rent control in cities like New York and San Francisco. Now let's understand rent control policies. The example you see on the screen is the market for apartments. P represents the rental price of apartments and Q represents the quantity of apartments. And we have a demand and supply. For the apartments market, you know that there are different prices based on the size of the apartment and the location of the apartment. But let's assume that this is for one-bedroom apartments and the price that we see on the screen is the average price. So average price for one-bedroom apartment is $800, and let's assume that 300,000 apartments are rented at that price, which is the equilibrium without price controls. And now let's assume the government imposes a price ceiling saying that any landlord cannot rent one-bedroom apartments above 1,000. So this sets a maximum price in the market. Maximum price. Anything above, not legal. A price ceiling above the equilibrium is not binding. What does that mean? That means it has no effect on the market outcome. So if the price ceiling is 1,000, the market forces of supply and demand in the free market going to bring the price to 800 because this is the best price that clears the market. 300K people are looking for one-bedroom apartment and finds an apartment, and there are 300K apartments are supplied to the market at that rate. So remember this, non-binding means that this policy has no effect on the market outcome. Price is going to be 800, quantity is 300. Now let's look at an example of a binding price ceiling. This time government imposes a price ceiling below the equilibrium price. So this is the maximum price in the market. Anything above is not legal. You cannot ask to pay $800 for one-bedroom apartment because the maximum price that is imposed by government is 500. So this price ceiling is binding. Why? Because at $500, the quantity supplied is going to be here and quantity demanded is going to be here. As you see, there is a mismatch, and this mismatch is called shortage. So there will be 250 apartments in the market and 400 apartments are demanded at that price. And as you see, because of this mismatch, only 250 apartments will be rented. The minimum of quantity supplied and quantity demanded. And remember, this policy is binding because we no longer have $800 price and 300 units in the market. Instead, now we have less amount of apartments available at a lower price, yes, true, but this creates a shortage. Why? Because people are waiting in the line to get the limited rent-controlled apartments. And in the long run, this creates a bigger shortage, this policy. The reason is simple, because the demand for rental apartments are more price elastic. When the price is lower, more people are going to demand in the long run for limited rental places. Because of shortage, sellers must ration the goods among buyers. You are the landlord and you see that there are too many people are asking for rent-controlled apartment because the price is cheap. What you can do, you can ration the mechanism. So the rationing mechanisms are long lines. If a person waits long in the line, gets the good or service. Or landlords can discriminate according to their biases. They might choose a family over a single person, or they might choose different races based on their biases. And they are often unfair and inefficient. That means the goods do not necessarily go to the buyers who value them most. If there is the price mechanism, if it's 800, then that rental place goes to the person who valued that price. But once you distort the prices, change the prices, then the market outcome is inefficient. The next policy that we are going to talk about is price ceiling. And to understand this policy, we are going to talk about minimum wage. But I want you to understand this market well. This is a resource market. Resource, remember, resources of production, physical capital, land, and labor. And this is the market for labor. And on the vertical axis, you have the wage, because this is the rate you pay for labor services. And on the horizontal axis, you have the labor hours. When we talk about the demand, this is the demand for labor. And remember, demand for labor comes from the businesses. And this is the supply of labor, which in this case, households supply labor services. So when you are on the job market looking for a job, you are actually ready to supply your labor hours. So the intersection of supply and demand determines the price. And now I want you to think this as the labor for unskilled. There are many labor markets depending on your skill, okay? The wage rates are totally different. For a skilled labor, maybe this wage rate is $60 per hour. But now we are talking about jobs that does not require education, training, or experience. These are unskilled labor. And equilibrium without price controls, let's say it's $9 per hour. And at that price, 500,000 people find job for an unskilled labor. Now let's first see the case for non-binding price floor. And government imposes a price floor of $7. So what does that mean? Price floor always determines the minimum price. So you cannot pay lower than $7, not legal. Anything 7 and up are good. If that is the case, remember the market forces of demand and supply are going to bring the equilibrium to 9. And $9 is a legal price. So with that price ceiling, the result will be $9 and 500,000 workers. A price floor below the equilibrium is not binding, has no effect on the market outcome. Wage rate is going to be $9 per hour and 500,000 employees are going to be hired. Now let's see an example of a binding price floor. Let's assume the government imposes a price floor at 10.25. So this is the legal minimum. What does that mean? Anything below is not legal. If that is the case, $9 is not an option anymore because you cannot pay labor $9 per hour. The minimum you can pay is 10.25. So if that happens, this creates a problem. Demand is here, supply is here, right? Supply, that means people are looking for a job, is much higher than the businesses are willing to hire. The price floor is binding and causes a labor surplus. So the demand, that means job positions available 400,000, and supply, that means people looking for a job, is 550. There are people looking for a job, but we don't have enough job openings for everybody. So let's see what experts are thinking for minimum wage. If the federal minimum wage is raised gradually to $15 per hour by 2020, the employment rate for low-wage US workers will be substantially lower than it would be under the status quo. So let's see what people are thinking. As you see, economists are not sure about this statement. There are people who are favoring an increase in minimum wage, and there are economists are against increase in minimum wage. And this poll shows that 34% of them agree, that means they favor that we shouldn't increase the minimum wage. 37% of them uncertain, and 29% disagrees with that statement. That means they are actually asking to increase minimum wage. Let's see some arguments about minimum wage. The minimum wage has its greatest impact on the market for teenage labor. The minimum wage workers are usually between 16 to 24 years old. And these are the people that does not have skill and does not have experience. And they are okay to accept a lower wage in exchange for on-the-job training. A 10% increase in minimum wage, according to the studies, decreases teenage employment by 1 to 3%. And this focus on the effects in the short run. Long run effects are actually harder to estimate, but more relevant, and likely it will be larger. And the long run effects, this will increase in quantity supplied of labor in the long run more. That means there will be higher number of teenagers who choose to look for jobs. And on the other hand, advocates of minimum wage is favoring to increase the minimum wage to $15, and their claim is that one way to raise the income of working poor, which means if you look at the minimum wage and now most of the federal minimum wages, most states is 7.25, and if you assume that you work 20,080 hours a year, the total income you earn is around 15K. And the poverty level in US is 13,000K. So it's slightly different, slightly above the poverty level. This is not a living wage, as you might guess, because poverty levels are determined as the 3 times of the lowest cost food for a month. It doesn't include most of the stuff that you need to live comfortably. But on the other hand, against the people who are against the increase in minimum wage says that there are not many people earning minimum wage at the poverty level. Advocate says workers who earn the minimum wage can afford only a meager standard of living, so they need to work 2 to 3 jobs to make the ends meet. Opponents of the minimum wage says that increasing minimum wage is not the best way to combat poverty. This causes unemployment, encourages teenagers to drop out of school, prevents some unskilled workers from getting on-the-job training. Minimum wage workers, less than a third of minimum wage earners, are in families with incomes below the poverty line. Many are teenagers from middle-class homes working at part-time jobs for extra spending money. Now let's do one example to make sure that we understand the price controls. Here you see the market for bicycles and it's in equilibrium. You can see the equilibrium price. It's $100 and 100 bicycles. We need to determine the effects of 3 policies. The first one is $90 price ceiling. So let's start with the first policy, $90 price ceiling. So the price ceiling here, as you see, going to be here, a horizontal line at $90. And this is going to be the maximum price in the market. That means anything above is not legal. Anything below is okay. So market equilibrium price, $100, is not a legal price. The prices are going to stop here. Okay, for that reason, this is a binding price ceiling. Look, compare demand and supply. Supply is 90 and demand is 110. This creates a shortage in the market. Shortage. Why? Because demand is higher than supply. So what is going to be the market outcome? Price is going to be $90 in this market and the quantity is going to be 90 as well. because we take the minimum of supply and demand to determine the quantity in this market. So this creates a problem in the market, as you see. The ideal one is here, $100 and 100 bicycles, but because of the distortions in the market, the prices are cheaper, the quantity is lower, but there are people that cannot find bicycle because of the shortage. Now let's look at the second example. $90 price floor. Again, I'm going to draw a line here. This time, this is the minimum price in the market. Price floor minimum. Anything below is not legal. So the next question we need to ask, is $100 a legal price? Yes, it is. Given this legal minimum, $100 is above $90. So the market forces of demand and supply bring the market to the equilibrium price of 100, and this price floor is not binding. The first one was binding, but $90 price floor is not binding. Now let's look at the last policy, 120 price floor. Now we are going to draw a vertical line at 120, and this is the minimum price. Anything below is not legal. As you see, $100 is not legal. Therefore, in this market, the prices could go lower as much as 120. So the price is 120, and the demand is going to be here, which is 60, and the supply is going to be here, 120. So the quantity is going to be determined by the minimum of 60. As you see, the market outcome has changed. Therefore, this policy is binding. Let's evaluate the price controls. Markets are usually a good way to organize economic activity. Economists usually oppose price ceilings and price floors. Prices are not the outcome of some haphazard process. It's the interaction of many buyers and sellers in the market. Prices have the crucial job of balancing the supply and demand. Therefore, prices are coordinating the economic activity. Governments can sometimes improve market outcomes. They want to use price controls. Because of the unfair market outcome, for instance, people cannot afford to pay rental places in San Francisco, so the government wants to help people who need housing, and they aimed at helping the poor, but at the end of this policy, often government hurt those they are trying to help. So what other ways we can choose to help those in need? We can actually introduce rent subsidies or wage subsidies, which in the form of earned income tax credit. The last policy is taxes, and government uses taxes to raise revenue for public projects. Government needs to spend money on roads, schools, and national defense. And here we talk about a sales tax, not income tax. Tax incidence is a manner in which the burden of a tax is shared among participants in a market, and the government can make the seller or the buyer to pay the tax, but we do not know what is going to be the burden of a tax, and burden of a tax, how it's shared, is called tax incidence. Let's see one example to understand what I mean by tax incidence. This is the market for pizza, and without any intervention, no sales tax, the pizza price is $10 and 500 pizzas are sold and bought in this market. Now let's assume there is a $1.5 per unit tax and government is asking buyers to pay the tax. Hence, a tax on buyers is going to shift the demand curve down. Why? Because it's more expensive for them to buy a pizza, so some people may consume less pizza in a month, and some people may totally stop buying pizza. So the demand curve is going to shift to the left because of this policy. And the new equilibrium is going to be lower pizza demanded. The quantity demanded is going to be 450, and the price of the sellers received is going to be $9.5 because the demand shifts to the left. It was $10, but demand shifts to the left, and the equilibrium price turns out to be $9.5. And now let's calculate how much tax is paid by buyers. So buyers pay $9.5 for the pizza, and the government is asking $1.5 tax, so the buyers are paying $11 for the pizza. And how about sellers? Sellers are receiving $9.5 because demand shift to the left. Now let's calculate the tax. Tax is the distance between here, $11, that the buyers pay after tax, and the equilibrium price after tax is imposed. So it is price buyers paid, this is the price buyers paid, PB, minus price sellers received, which is 1.5 is the tax. So now let's calculate the burden of the tax. Just think about that. Before the tax, buyers were paying $10 for a pizza. That was the equilibrium price. Now they are paying $11. So they pay effectively $1 from their pocket for the tax. So what happened here? With the increase in price, some people get out from the market, so the pizza prices dropped. When pizza prices dropped, buyers are actually paying $1 of the total tax of 1.5. Now let's calculate how much sellers pay for the tax. What is the burden of sellers? Sellers were receiving $10 before the tax. Now they are receiving 9.5. So now sellers are paying 0.5 or 50 cents of the tax burden. As you see, although government imposed a tax on buyers, sellers also pay some share, some burden of the tax. So tax incidence of a tax incidence, how the burden of a tax is shared among market participants. How we can find? It's very easy on the graph. This is the equilibrium price, okay? And here represents the price buyers paid minus the previous equilibrium, $1, is the tax burden on buyers, and the equilibrium price, and how much the sellers effectively received. This difference represents the burden of tax that sellers pay. So buyers pay $1 more, sellers get 50 cents less. Now let's see another example, this time $1.5 tax imposed on sellers. So tax effectively raises seller cost by 1.5 per pizza. Hence, a tax on sellers shifts the supply curve by the amount of the tax. So when the cost of producing pizza increases, supply decreases. Therefore, supply shifts to the left. We learned that in chapter 4. Because of this shift, look what happens. The quantity supplied to the market decreases, and the price of pizza, because of less pizza supplied to the market, increases. In this case, it's $11. And now buyers are buying the pizza at a higher price. This is exactly what happens in the market, right? Sellers usually reflect the tax onto price, and therefore prices increase, and buyers now paying higher prices for the same pizza. And sellers, since they have to pay tax, are receiving effectively less compared to no tax outcome. So here again, the difference between the price buyers pay, PB, minus PS is the tax. And when we talk about the incidence of the tax, buyers pay $1 and sellers pay 50 cents. The reason is simple. Because of an increase in the tax, prices increase, and therefore buyers pay higher prices and sellers receive lower price, and at the end tax burden is shared among buyers and sellers. So from these two examples, the outcome is the same in both cases. Whether you impose the tax on buyers or on sellers, the effects on P and Q and the tax incidence are the same. A tax drives a wedge between the price buyers pay and the price sellers receive. Let's look at this example, effects of a tax. The market for bicycles is in equilibrium as in the graph. Suppose the government imposes a tax on buyers of $30 per bicycle. And we need to find out new quantity, price buyers paid, price sellers received, and incidence of tax. You don't need to shift the demand curve to find out the new price. You can do that, it's up to you. But the easiest way is to find the tax wedge. Tax wedge that amounts to $30. So if I draw the tax wedge here, it's not $30. Why? $5 here, $10 here, $15. So this is not the right tax wedge. I can't draw it here too because it's more than $30. So the right line is going to be here. I draw a line between demand and supply. Okay. And the amount of this line, length of this line is $30. Look at 10, 10, and 10. And the intersection of this line with the demand curve is the price buyers pay. Buyers are paying 110. And the intersection of this line and the supply curve is the effective price that sellers receive. So sellers receive $80. So we can write PS is 80, PB is 110, and then quantity is here 80. And now let's talk about incidence of tax. So incidence of tax refers to the burden of tax. Compare this 110 with the previous price of 100. 100 is here. Now buyers paying $10 more. So the $10 of tax is paid by buyers. Sellers were receiving $100 before. Now they are receiving $80. So you see the $20 of the tax is paid from sellers. So incidence of tax, buyers pay $10, sellers pay $20. The next topic, we talk about elasticity and tax incidence. When a good is taxed, buyers and sellers of the good share the burden of the tax. But how exactly is the tax burden divided? Depends on the elasticity of demand and elasticity of supply. Let's see one example. In this example, there is inelastic demand. You see the demand curve is more steeper compared to supply curve. And look at the tax wedge between demand and supply. And look at the price without tax. And you see the majority of tax is actually paid by buyers, and sellers pay compared to buyers much less. So what we understand from this example, it's easier for sellers than buyers to leave the market because they are more price sensitive. So buyers bear most of the burden of the tax. Now let's look at, in this case, elastic demand and supply steeper compared to demand. And now let's draw the tax line between demand and supply. And now look how much buyers pay, how much sellers receive, and the burden of tax is sellers' share of tax burden is much higher compared to buyers' share of tax burden. So the reason it's easier for buyers than sellers to leave the markets, sellers bear most of the burden of the tax. Here one example you can read who pays the luxury tax. In 1990, Congress adopted a new luxury tax on yachts, private airplanes, first jewelry, expensive cars. The goal was to raise revenue from those who could most easily afford to pay. So the idea was to get tax from the buyers. But luxury items demand is quite elastic and supply is relatively inelastic. And what happened is that demand is price elastic, and in the short run, supply is inelastic, and therefore the tax unfortunately mostly paid by sellers, and the quantity in the market dropped, so many of the people lose their job because of this policy. Hence, companies that build yachts pay most of the tax. And this is the end of this chapter. Thank you.